This is my third consultation call with Trade Brigade. I'm day trading knockouts and I need sleep, but we got work to do. And this is episode 3, part 3, same number, of the new series I'm making today. And today, Trade Brigade is going to teach us how to manage our expectations with the use of market internals. This is a little bit different than the other video talking about market internals because this covers more of when you should have more haste to enter. And when you should be more hesitant to enter a trade as well. As you gain more screen time experience, you're going to be able to see exactly what it is that I mean. It does take time and experience to be able to fully understand, but again, the video is going to be covering the concept more and more, so you're going to be able to learn more. And again, this is from Trade Brigade. These are his mentorship consultation calls. Again, don't take my advice from it. I've had over a year of these consultation calls with him. It's been a year experience with him, a year and a half experience at this point. Honestly, a little more, like a year and 8 months. And again, it's been hard work, lots of sleepless nights, lots of days of struggling. But again, it keeps paying off more and more the more that I keep working hard at it. And again, I do believe the same thing can happen for you. So again, with that being said, don't forget to like and subscribe to Day Trade Knockouts. Stay safe, stay green. Peace out to my fellow millionaire day traders.
Cool. Yep. Yeah. So that kind of covers the Friday trade in question there. Yeah. What else? What else you got for me?
Let me see. So the next one is as I've been getting more practice and experience with the marketing stuff, the more I start to understand that not every trade is the same. Mm-hmm. And some trades, I'm not even necessarily talking about gaps or gap up or gaps downs, but say even in the middle of the day, some trades you need to be a little more patient and wait for double confirmation. And sometimes it's you need to go get in immediately. It's a faster entry. So what context do you look for to be able to tell you when it should be a faster entry or if it should be a slower, okay, hold your horses there, buddy?
Yep. Gotcha. So that's going to boil down to the tick, really. The tick and overall, if the markets are moving in sync. So for me, as you start watching the same tickers over and over and over again, primarily the SPY too, you'll just get a really solid sense for what's a really fast tape and what's a really slow and lethargic tape. So today, for example, was extremely slow. And the market wasn't doing anything, right? In the opening range, it just kind of went sideways. The breakdown was slow. If you were watching the ES futures, we're moving literally tick by tick and going back and forth between, 3/4 and the whole number, 3/4 and the whole number, and just hardly budging to the downside. So when you see days like that, usually it's going to be paired with a very mild tick. So let me go back to the full internal screen. And see how in the tick, there's really no extreme reads better than 500 in the up or in the downward direction. Notice that the closes aren't really down here. There's not a lot of wicks extending past negative 800 either. So if the tick is staying compressed kind of in this range in the midpoint for the most part, then it's a day to dial it back for sure. And the other thing to watch out for is what the other market indexes are doing. The market will usually move much faster when all of these things are moving in the same direction, right? So on today's session, you would have noticed that the IWM was basically falling off of a cliff and the QQQ was holding up kind of resiliently, and then ultimately ended up outperforming on the day, right? Mm-hmm. You can see this trend in here. So when these things are moving divergently from one another, then that's a day to dial back the speed expectations and how fast you need to actually have an execution. Whereas when they're all moving in sync and you see opening drives were really strong, right? There's no tests of the opening print. The opening range was extended, right? So the first 5-minute bar moves, let's say 50 cents to 75 cents instead of 10 cents. Those are the days where you're okay, there's some momentum behind this market today. So that'll usually be paired with, likely in the tick, pretty extreme reads up and over 500 or, well underneath negative 500 if we're falling down aggressively. And those are kind of the clues that I look for to tell me to be, pedal to the metal or a little bit slower. And when the tick is compressed like this, not getting too far out of range, those are days where you would want to be a little bit more patient with your entries, patient with your exits in terms of expectations of getting to a particular destination. Like on today's session, there was no real reason, as the tick was so compressed here, to start to target anything, even remotely close to prior highs of day or a breakout here over those highs. The only trade that I even thought was worth taking, and this was the only trade of the day for me, was the second higher low on the day. If I zoom in on the SPY 5, this hammer right here, basically. So we really fail to break down, make aggressive new lower lows from this kind of section right here to here. I mean, they're definitely lower lows, but they're not. There's nothing there that's so aggressive. So we rally, and the most important part about this, of course, is that we exceed this previous high. So the only entry I really saw was this hammer candle that closes back inside of the red bar's range. We take out the high. We know that we can enter over that. Look for again, this was the target, just the pivot high from back here, highs of day. It wasn't really, the expectation was not for a big break. And we knew that because the ticks were compressed, the IWM was divergent, the QQQ was rallying, right? There's too much push and pull. I don't know if you ended up, well, I'm sure you did because Jim Dalton and Peter are fairly close together, but Peter always calls it push pull. Peter Resnicek from Shadow Trader, right? So when there's so much push pull, it's just hard for the market to do anything more substantial because exactly that. Like small caps are saying, no, we're not ready yet. Tech is saying, yeah, it's time to go. And the SPY is kind of caught there in the middle, like, okay, what do we do? I guess we just go sideways. So that to me is kind of, those are the indications that I would watch for, again, I guess to bring it back to the question, aggressive entries, dialed back entries, here all day. Like I wasn't, this liquidation, whoops, sorry for the zoom there. This liquidation break from the afternoon, completely liquidation break, right? Came out of nowhere. There was no bearish pattern. Technically, this is a bullish pattern, ascending triangle building. And it's just longs who are tired, right? Longs who are tired close out. And then it gets retraced, right? So it's not that new money sellers are stepping in. It's just that the market was so lethargic on the day's session. There was just such a lack of follow through that nobody wanted to be in this thing anymore. And you can't really prepare for these types of things. But as the market is chopping around like this, generally the expectation is like, hey, there's no reason to really believe that there's going to be a massive break of range. And if there is, then you would just reassess. So I guess that boils down to an expectation and taking the clues in from that perspective.
Okay.
Yeah, like there's no clear cut